Okay, why don't we get started? So my name is Mark LaMonica. I'm the product manager for Morningstar Premium and Morningstar.com.au, and I've been told to introduce today's episode as saying we are going to hear the scandal on tech stocks. So that will be exciting. Everyone likes a little scandal, right? A couple housekeeping items. So number one, we do not have a webinar next Tuesday. So Shani and I are going to the ASA conference. So if anyone is going to the Australian Shareholders Association conference at the Hilton, we will be there. So anyway, we will do that webinar that was scheduled for Tuesday on Thursday. We have updated the schedule already. The other things is anything you hear today is general advice. I don't know anything about you. I can't offer personal advice. And if you are in New Zealand, then you should go to our website, morningstar.com.au, to find the FAP. And also, if you are looking for personal advice, New Zealand thinks you should go to a financial advisor, so do that. All right, we'll get started. The other thing is I would love questions. So there's a Q&A button on the screen, so ask any questions that you have. And hopefully this will be an interesting one because this scandal with tech stocks has changed. So I did this one originally in February, and market conditions have changed a little bit. So hopefully that will be exciting. All right. Is that introduction okay? I said scandal twice. Okay, so what are we talking about? We're going to talk about the sector in general. We'll look at some Australian shares, but some of the big drivers of the market over the past few years have been these 5 companies. So Facebook, Apple, Amazon, Microsoft, and Alphabet, which is Google's parent company. So we'll talk a little bit about all of them today. And I used to have, when I did this in February, there were lots of stats about how basically these companies drove market returns, and they did for a very long time. But things have changed, and that's what we'll talk about. All right, so why are these stocks important? Why is this sector important? We'll start out talking about that. Okay, so what I've done is I've looked at the S&P 500, so the 500 biggest shares in the US. And I've taken 2 different looks at index returns. So market cap weighted is how indexes are traditionally weighted. So basically what that means is that the larger the company from a market capitalization standpoint, so that's shares times share price, the larger the company, the more it makes up of the index. An equal weighted index, on the other hand, is a situation where all 500 companies, in this case, in the S&P 500, get an equal weight of the index. It doesn't matter if you're the biggest company in the S&P 500, which is Apple, by the way, or the smallest company in the S&P 500, which I don't know what that is, but this would have been more interesting if I did. But that means that the money's spread across all of the different securities. And we can sit back here, and we obviously have gone back 5 years, and we've looked at returns over different periods of time, and we can see a couple different things. Basically, market cap weighted over these longer time periods, you can see, had better returns, and these are obviously annual returns, so it does compound over time. Then we've seen a pretty dramatic shift, and really the shift happened this year. And what has happened is technology has started to underperform. So these were all of the different, so technology was really driving a lot of the returns in the market. And they were growing to be bigger and bigger and bigger parts of the S&P 500, and then we're driving those market returns. Now we've seen a bit of a rotation, and we talked about this the other day. We were looking at value and growth and showing that we've had a rotation out of growth into value. Same thing is happening with the technology sector. So you can see on a 1-year basis, and these are shockingly good returns, but remember what kind of market environment we were in last year, and year-to-date returns, we can see this outperformance starting to happen. But the point is, why do you care? Why should you care about the technology sector, and particularly these giant technology stocks? Is their fortunes are probably, well, not probably, mathematically going to drive the index. So almost everybody is invested in market cap weighted indexes, and that's the way that the index is actually calculated. There are products, ETFs, that are equal weighted indexes, but these particular shares who have grown and are still very large parts of the index are going to have a going to have a bigger influence on where we get from a return perspective. So people that say that they are passive investors, which means that they are not taking any sort of position, well, yes, that's true in a way, but also you just need to understand what kind of index you're actually following. When you're following these market cap weighted indexes and we get to situations where there are outsized influences over the market from a particular company or a sector, that's really the bet that you're making. All right, so over time, and this is obviously a little bit old of a chart, but this one's updated on the right. So over time, the tech sector has become a larger and larger part of the S&P 500. Now, this happens for a couple reasons. Number one, obviously, there have been more tech companies that have been started. But the other thing that's happened is, of course, as those companies have performed very well, they make up bigger parts of the index. So this giant spike right here is the dot-com bubble and then subsequent crash. And this is kind of where we are right now as we sort of go through over time. You've seen it's built up to being a bigger percentage of the index. So this data is a little bit old. It was October 31st, 2020, but still significant portions of the index. Over here, and I took this morning, so that's as of May 21st. So I was just looking at a S&P 500 ETF. So you can see both on the fund perspective and the index perspective, you can see different sectors and what they accounted for in the index. So right here, technology. Technology is a very, very big part of the index. So that, of course, is what we're talking about today and why we're talking about it. A couple notes. Some of the companies that we're looking at don't fall in the tech sector. So Google and Facebook are communication services, which you can see are also large parts of the index. And Amazon, of course, is retail. So that's down here in this consumer defensive category. But they are big parts of the S&P 500. And here we go, right here. So you can see these are the top 10 holdings in the S&P 500. You can see Apple, Microsoft, both over 5%. The other companies I talked about, Amazon, Facebook, both share classes of Alphabet, so that's Google. So you can see we have the top, I mean, at this point, the top 5, if we're combining those two Alphabet. So you can see they make up a very large part of the index. So that is why we need to care about this as investors. Okay, so a good question from Angus. So Angus is saying weightings change as companies grow and shrink. How do weighted funds balance weightings over time? Very simply, they just rebalance. Now, one very important thing to know about rebalancing, if you go into an equal weighted index, and you can go into the prospectus and see how often they rebalance, so it's either quarterly, potentially every 6 months. But one really important thing to remember about rebalancing is what's happening with rebalancing. Well, the winners are getting sold because they have gotten beyond their equal weighted allocation, and then they're buying the losers. Now, rebalancing can be a good thing, but the one thing to be aware of is those capital gains that are going to be generated off of those sales, they're going to get distributed to you. Now, obviously, that will get netted out with any of the losses, but if the whole index is going up, potentially you are going to get a taxable event there. So that was a good question, Angus, and something we should watch out for as investors. All right, so what I wanted to talk about today is why does everybody love tech stocks so much? So I picked Uber. So Uber as an example. Well, one of the reasons that that everyone loves tech stocks so much is because they are very asset light. And I think Uber is a good example because Uber is something that everyone can understand. Because people actually take it. So let's look at Uber versus a traditional taxi company. So what happens with Uber? Well, Uber has very few employees, right? So all the people driving the cars are contractors. They also have no cars. They don't own any of the cars because people are driving around their own cars. If we compare that to a traditional taxi company or many traditional companies, they are asset-heavy companies, meaning they have to invest in a lot of assets to actually grow and expand. And the good thing about tech companies, because they are asset light, you get better return on assets because you have less assets. They are scalable, meaning you can grow very, very quickly. and more of the revenue flows to the bottom line. So that's what you get out of being scalable. And scalable basically means that the company can grow without adding a lot more new employees. The company can grow without adding a lot more assets. So we're going to go back and use an example. We're going to use General Electric. We're going to go back to 1999, and we're going to look at General Electric. And the reason I picked General Electric, because General Electric was the biggest company in the S&P 500 in 1999. Actually, I think it was second. So I think Microsoft was actually first. So remember, this was the tech bubble. So Microsoft was first, led by Bill Gates, who's been in the news a lot. Probably not like he'd like to be, but we'll save that scandal for later. Nobody wants to hear my take on Bill Gates. Anyway, so I picked a company, General Electric, that does represent more of sort of an old school type of company. So if we think back before the technology boom and we think about companies, at the end of the day, having more assets were how the companies grew. So think about these heavy asset companies. So General Electric has a finance arm, but General Electric still, especially in 1999, very involved in manufacturing. So if we go back and think of an old traditional company, what did you do? You built a factory, you produced goods in that factory, and you sold them. And then if you wanted to expand, what'd you have to do? You had to build a second factory and fill it with workers, and then a third factory as you expanded. So a lot of these traditional companies were asset-heavy companies, and having a lot of assets mattered and benefited the company because that is literally how you grew. And GE is an example of this. And the way you can see this going and looking on a balance sheet is you can look at, and this is an earnings statement. Oh, so we'll get to the balance sheet in a second. I'm getting ahead of myself. That's the next slide, right? It is. Amazing. Okay, so we're getting a little ahead of ourselves. So one of the things that being an asset-light company allows you to do is allows you to focus on your net profit margin. And generally these companies, technology companies and companies like them, have a lot higher net profit margin. So what are we talking about with net profit? We are simply looking at revenue comes in the door, so you have sales, and then you have earnings. And what's in between those are all of the costs of doing business. It's the cost of paying your employees. It's the cost of depreciating some giant asset, a factory that you built. It's the cost of keeping that factory going. So what we can do as technology companies is technology companies can scale, meaning you don't have to hire a bunch of employees, you don't have to build another factory, because if you create a website and that is your product, you can have 100 people on your website or you can have 1 billion people on your website, and there isn't that much of a difference, especially because you can outsource a lot of the infrastructure now to something like AWS. So we looked at GE, and GE was a great company in 1999. It's fallen on some tough times, but this was like the golden era of Jack Welch, who's one of the most famous CEOs. They were very, very focused on cost cutting, so all this stuff, Six Sigma, and the rest of their cost cutting initiatives. So they had a very high net profit margin, but it pales in comparison to some of the leaders, tech companies, Microsoft and Facebook. So that's the first thing that is different about tech companies and why investors love them, because this net profit margin basically means, and if a company is scalable, means this net profit margin is actually going to increase as they sell more goods, goods and services. And investors like this because more of the revenue that they generate in the future flows to the bottom line, which is what investors like. It's what you own part of as an owner of a company. You get your share of their profits. The other thing is, of course, the balance sheet. So the balance sheet is, of course, where we record all the assets and the liabilities. It's a snapshot in time when financial statements are produced. And what we're looking for is right here, this line, property, plant, and equipment. So property, plant, and equipment, if you think about it, is obviously been designed for this sort of old school type of company where this is what they did. They own property, they built a plant, they put a bunch of equipment in there to manufacture it. So what you'll see is that the assets, and it's an asset and it gets depreciated over time, and it's an asset because you need this to actually produce the goods that you're gonna sell. So it gets depreciated over time. but return on assets, so the amount of money that companies are making off of their set assets that they have, depends on, of course, how many they have. So GE's return on assets, and remember, this was a great company, second biggest company in the S&P 500, was 2.64%. And then we start comparing it to some of these tech companies. Well, they are a lot higher. So if you go through these different companies, Apple actually manufactures something, right? So they've got computers and they've got phones. Now, of course, none of that's done in their own factories. They've outsourced it all. So they don't have to build factories to do it. But if you look at Microsoft and Facebook and Google, they hire a bunch of developers at the end of the day, developers and designers, but they do not have to build factories because there's nothing to produce in the factory. So that is good question, Lisa. I'll get to the question in a second. That's another real advantage of these asset-light companies. So I really like this chart, which I wish I produced, but I just found it on the internet. But anyway, all right, so this chart's a little bit complicated, so I'm going to spend a couple minutes explaining it. So this is once again looking at this notion of valuing industries based on physical assets. So once again, factories, things like that. So what we've done, or what the people that created this have done, so I think this is Harvard Business Review. So what they've done is they have plotted different sectors on two different areas, right? So they've looked at average net PP&E, so that's property, plant, and equipment. So in this case, they are looking at property, plant, and equipment as a percentage of total assets. So basically, physical assets, land and buildings and vehicles and everything else, versus all the other assets they've had. And then the other thing they're looking at is they are looking at the average multiple. So that is, how much does the average investor pay for $1 of revenue? So this is the price to sales ratio. So of course, higher multiples mean investors are willing to pay more. Now remember, this is revenue. And we talked about before that with higher net margins, this revenue is going to flow more easily to the bottom line. So they've, of course, come up with dumb names for all the different areas on here. But if we sit here and look at these different industries, you can see ones that are getting very high multiples on their sales and very low physical assets. So, of course, we have tech services, finance. Finance is the same thing in many ways, right? Financial companies. Well, if we look at financial companies, I'll do a little bit of an aside on them, is their assets are not property, plant, and equipment. Their assets are financial assets. So they're still probably getting very low, or they're still definitely getting pretty low net return on assets, but their assets are financial assets. So at the end of the day, there's obviously a bunch of regulations with banks, making sure that they hold appropriate capital to account for anybody not paying back their loan, and those are the assets that they hold. And health technology. So yeah, once again, same type of thing. We go all the way back down here, and we look at things that are investors are not paying a lot for their revenue, and they have very high property, plant, and equipment as a percent of their assets. Everyone you think it is: energy, minerals, utilities, transportation, all this stuff, right? What do I do if I'm a utility? Well, I need to build a lot of power plants. So what do I do if I'm an energy company? Well, I have to go dig something out of the ground, transport it a long way. All that takes a lot of property, plant, and equipment. And then in the case of petrol, refine it, or refine oil into petrol. So lots of work that needs to be done in order to do that, and lots of property, plant, and equipment that needs to be done. All right, let's see. We've got a couple questions. Wow, both from Lisa. Lisa, you are winning the question. So Lisa, of course, has an alpaca. Lisa is not a few alpaca, sorry. Lisa will not be available to attend on Tuesday, but now we're not doing it, so it's good news. All right, so Lisa says, is it possible to have various ETFs on the ASX that specialize in these overseas tech stocks? So we're actually recording a podcast on thematic ETFs right after this, where we're going to be talking about one that I think is absolutely ridiculous. There is something called the FANG ETF. So you can go buy the FANG ETF. So you know how you buy ETFs because they give you diversified portfolios with one trade? Well, the FANG ETF has 10 securities on it. And listen to the podcast, but that is a place you can go and buy technologies. The other things you can do is buy anything that's related to the NASDAQ. So the NASDAQ is the exchange in the US where a lot of these technology companies trade on. So you can go buy NASDAQ 100 ETFs and funds and things like that. So you can do that. Okay, so Lisa has a good comment. So she says it's interesting to note that GE's investment securities were twice as valuable as property, plant, and equipment. That was when interest rates were much higher. Yeah. So the one thing about GE is GE did have a large. GE Capital was basically their financial services arm, and a lot of what GE Capital. We'll go back to what Lisa was looking at. So a lot of, here we were at, yeah. So a lot of these financing receivables is all they're simply doing is they set up GE Capital to finance the purchase of the things they sold. So, GE was, it still does, sells power plant, health equipment, lots of expensive stuff, and basically they were just financing it for their customers. So they would make money selling it, and then they would make money on the financing as well. So that is what all those financing receivables are. And then GE Capital, sort of the story of what happened with GE, 8 years after this, is they continued to build up GE Capital. And then the GFC hit, which did not go very well for them. And GE has never really bounced back from the GFC. All right, so Rodney, who always answers all the questions, and sent me an email today, which I will get back to you on. So FANG is this ridiculous ETF that has 10 holdings in it that is picked for, forget the criteria, but we put it down, basically they are picking popular stocks that are overpriced. So they said popular growth stocks. So anyway, it's probably obvious what I think of that one. So NDQ, that's the NASDAQ ETF, and also Asia. So Asia is the tech titans, Asian tech titans, another thematic ETF. All right, so Randall is asking a question: in which quadrant is Bitcoin and blockchain? All right, well, we'll get prepared to be upset at me. So one of the problems with Bitcoin, interestingly enough, is that it takes a ton of electricity to actually mine it. And one of the reasons we've obviously seen this enormous drop in Bitcoin in the past week, Will's sitting over there thinking buy the dip, which I know he did. But one of the reasons that's happened is a lot of the comments that came out of China, particularly comments around there are areas of China that have very cheap electricity, and a lot of Bitcoin miners have set up there. And the reason that they have cheap electricity is it is in areas where there's abundant coal, for example, and as the Chinese government is trying to hit emissions targets, they're realizing that they need to get rid of this. So what they've done is they've come out and not only made statements around the use of Bitcoin, but those are old statements. So so Chinese banks do not accept Bitcoin, for example. But one of the things that came out was they were talking about potentially shutting down some of these miners. So that's one of the reasons that Bitcoin dropped so much last week. So I would say that Bitcoin, for a currency, is probably over here because it does take a lot of physical assets, so servers and electricity. It does take a lot to actually support the mining of Bitcoin. Now, Bitcoin, of course, is not a company. They don't own any of those assets. It's all outsourced to other people that are going through and mining it. But yeah, that's my little sort of tongue-in-cheek place of where to put Bitcoin. Will would probably put it up here in this quadrant, but Will's muted me the whole time? Well, that's a relief for probably everybody involved. All right. Okay, so we've got a question from Chris. I can't speak. but I might be on mute, so it doesn't matter. So he said, are the FANG return on assets figures a backward-looking indicator? Can investors determine a turn point back to value stocks based on this information? Okay, yeah. So let's talk about how this return on assets works. So return on assets obviously only works if you're earning an actual return and earning earnings on where you are. So that's where with a lot of these startups. So what I'd say about technology companies is they are great when they scale, but also you have this problem of you've got to start the company and go through a period where you are not making any revenue. So with a lot of these, if we think about Facebook, for example, Facebook was started way before they actually had ads on it. And so for years and years and years, they were trying to generate traffic and users with the notion, and obviously it's turned out very well for them, with the notion that they would be able to translate those users into revenue at some point. But for years, they didn't have it. So you see a lot of these tech companies that as they are trying to build their product, they are very, very cash flow negative. So, at that point, there's no return on assets. And the question, of course, is can they get to a point where they can actually scale this? And all of a sudden, yeah, you're paying, and these are not assets, but you're generally paying people either in equity, so you're giving them options, or you're paying them a lot because you need really smart, talented people who command high salaries to develop these products with the hope, obviously, that it will catch on commercially and then it will sort of start to scale. So, I mean, as an investor, where you want to catch this stuff, well, Facebook, you should have bought it. In retrospect, I was making fun of it when it came out, but Facebook had an enormous fall the first day when they IPO'd. So that would have been a good time to buy it. But yeah, I mean, I think where you want to buy these things is as they start to develop scale. And obviously that means you're buying them when they are pretty small companies, but if you're waiting for them to turn a profit, just once you start getting the idea that they're actually going to build scale off of that, because that will increase that return on assets if they're scalable and also increase that margin. Yeah, so good, a comment by Vince. So Vince says, regardless of figures, technology is here to stay and it's going to grow. It is, I completely agree with you, but we are trying to look at this from an investing standpoint and determine if right now technology is a good place to invest. So I'll go back and then I'll go on my, Shani calls them rants. I'll go on my little Jeremy Siegel rant. Okay, so technology in 1999, as we ticked into 2000, was here to stay and was going to grow, but you didn't want to invest in it here, right? So at that point, obviously the excitement over technology and excitement about what could have happened or what the potential was, which has largely been realized, but the excitement got a little ahead of itself. So as investors, what we need to do is figure out, okay, are these companies actually great investments? And they can grow significantly and technology can take over more of our lives without it being a good investment. And the Siegel book that I'm referencing, which I think I said last week, also, I'm like a one-trick pony here, is he went back and he looked at, and he did this, and I'll get the years a little bit off. He did this in the early 2000s. I think it was maybe 2007. He wrote this book, and Jeremy Siegel's a professor at Wharton, and he went back and he looked at the best returning stock in the S&P 500 with dividends reinvested from 1925 to whatever period this was, 2007, I think. And the best performing stock was Philip Morris. Now, Philip Morris is a cigarette manufacturer. Philip Morris, and during this time period, a lot of things happened. Number one, smoking peaked in 1961 in the U.S. and came down significantly since then. There were all the lawsuits for obviously the harm that cigarette companies were doing to their customers. Now, advertising was cut. Really, really bad time. If you were just looking at the industry, you would think that would be a terrible investment. But $1,000 in Philip Morris turned into $380 million in 2007. It's over $1 billion now. So it was a great investment, although it was a shrinking industry. And part of this was because there was such a mismatch between expectations of investors and what actually happened. And what we have to realize as investors, and we did a podcast on this last week, right? What you have to realize as investors, it's that difference between expectations that are baked into the share price and that the market has, and what happens that's going to drive returns. So the growth of an industry on an absolute basis means nothing if everybody thinks it's going to grow and has already priced that into the stock. So that's where we have to be really careful as investors. And I see a lot of, on some of these like chat boards I follow, I see a lot of this stuff where people are like, oh, this company is in this great industry, this company is going to grow significantly. And I sit there and I say, yeah, but everyone knows that and thinks it already. So you're not uncovering anything new. The only way you're going to beat the market is to have an opinion that differs from the market. So you could think that technology is actually going to grow even faster than what the consensus is. But if you just agree with what everyone else does, you're not going to beat the market. You should probably just buy an index fund. But anyway, that's my mini rant. Did that count as a rant? Okay, Shawnee's shaking her head, yes. So let's look at where we are today. Clicking through all these. All right. So got a couple different charts on here. I looked at, over a 10-year period, the market fair value. So this is our price to fair value. So our analysts go and they analyze stocks and set a fair value on all the stocks. So that's what they think it's worth. When we compare the price to fair value, we are comparing what it's trading at versus what we think it's worth. So you can see, and this is the technology sector in the US, we'll get to Australia in a second, and you can see that we do think it's pretty significantly overvalued at this point. So up around 10, 11% overvalued, and that is way more than we ever think you should buy something because there's no margin of safety there. So the margin of safety, of course, is the difference between what you think something is valued and the price that you're actually willing to pay, taking into account all the fact that we don't know what's going to happen in the future. So that's technology. The other thing I wanted to point out, which we were talking about earlier, is you can see these are sector returns in the US over different time periods. And if we look at technology, we can start to talk about, obviously 1 day and 1 week are relevant, but if we sort of start to go back to this 3-month period, you can see that technology, the market's still going up, obviously, but technology is significantly underperforming most other areas. And this is this sort of rotation back to value. So if you see, and this is a very short time period, doesn't mean this is going to continue, but you can see some of these sort of traditional value in sectors, basic materials, real estate, energy, financial services. Some of these real value sectors have outperformed significantly, which is interesting. But then, of course, if we go back 3 years, we can see technology is way ahead. So this is what some people are saying may be the start of a rotation away from some of these growth stocks, some of these tech companies that have been doing very, very well, into other sectors. So we will see. As I said, it is way too early. And let's look at a couple companies. So let's look at Australia. So Australia, one of the things I talked about, concentration of indexes, Australia has a very small part of the ASX that are tech companies. But we've got this WAX phenomenon, because everyone likes to come up with acronyms. We've got this WAX phenomenon that is these 5 companies right here that have had a terrible year. And you can see our analysts, we don't cover 2 of them. We think the other ones are very overvalued. So WiseTech, a 3. So a price to fair value means that we think it's 200% overvalued. Same thing for Xero, 155%. Afterpay, we think, is now 23% overvalued, but all of these stocks have had a very, very poor performance. And on the US side, we go through this same group. You can see Facebook and Google have done very well. And by the way, these are the indexes. So that's the Aussie index, 3-month performance. I'm using VAS, Vanguard Australian Shares ETF, as a proxy for that. Then if we go back and we look at the US. So this is a S&P 500 ETF here in Australia, and this is the hedged version. So that basically means that currency movements, I wanted to remove currency movements. Currency movements are not accounted for or are hedged away so that they don't impact returns. So if you sit here and look at Facebook and Google have obviously done very well, but we're starting to see some laggards. So Apple, for instance, not doing so hot. And this is a very short-term performance. So once again, this could potentially indicate that maybe there's a rotation, or 3 months from now, we could be looking back and Apple could be up another 20% and could be far outperforming the market. But what I'm just trying to talk about is what has happened the last couple months. People are saying maybe it's an inflection point, but just something to think about, that if we do see continued underperformance by these tech shares, then what happens is if we go back and look at the overall indexes, that this market cap weighted index will get dragged down by technology because it makes up over 20% of the index. Then you've got all these giant companies that collectively make up a lot, right? 10% of the index is in Apple and Microsoft. You could see indexes started to be dragged down just as they were dragged up over the previous years. All right, I've got some questions. Oh, now I lost them. All right, so the anonymous attendee is asking about coverage. Yeah, so we obviously don't cover two of those WAC stocks in Australia. The coverage decisions are not up to me. Our analysts decide. And what they're trying to do is, obviously with the number of analysts we have here, they are trying to cover stocks that investors in general are interested in. And I can't answer the direct question why they don't cover individual securities, but that's really their approach. But they are independent and they do get to make those decisions. Okay, so Paul has a good question, which is very relevant to the podcast we're about to record and that we will release on Sunday. So he's asking P ratios for ETFs. So I think he went to the ACDC page, which I was on. So ACDC is basically this play on battery technology, and obviously the band's name. But yeah, so ACDC looks at two different things. It looks at producers of battery technology, and it looks at lithium miners, because lithium is a big component that goes into, big raw material that goes into batteries. So that's what ACDC is. And yeah, I noticed this too, and we talk about it on our website. So Paul says the P ratio for ETF, he notices NA for ACDC. So it says NA on their website, not applicable. It's because it's negative. Now, Paul points out, should instead show a negative price to earnings ratio. Yeah, it should, but that was a marketing decision, I believe. It was a marketing decision to just say that if the PE ratio is negative, we just won't show it. But you can show a negative PE ratio because you can calculate the negative earnings. So what that means is, because there's no PE ratio, that means that collectively the 31 securities, and there's 31 securities in this ACDC, I think I called it Frankenstein ETF, but there's 31 different securities in there. It means collectively they aren't making any money. Now, we know we can figure out how much money they're making if you add them all up, add up their earnings. So yeah, they could show a negative PE, but I believe that was probably a marketing decision. Okay. Okay, all right. This is a good question. I remember I have another slide to show. Or no, I showed this slide, but it's a question I think related to this. So what the anonymous attendee is, sorry for all the flicking around, what the anonymous attendee is saying is the price to fair value ratings of the big five tech companies are starting to look okay, especially Amazon. Yeah, so what I would say is these are, of course, our valuation. So much as I was talking about in the other slide, and I forgot to do on this one because I'm an idiot, is wanted to go through these. So Apple, we think 1.11 means that Apple, we believe, is 11% overvalued. But anything that's below 1, we think is undervalued. So Microsoft, 0.9, we think it's 10% undervalued. So yes, I agree with you that the big five tech companies on here are starting to get into a zone where, according to our analysts, they believe they are getting attractive. So this, in this case, 10%, 18%, I'm just proving I can do math. As investors, we have to decide where we think an adequate margin of safety is to invest in them. So these are obviously these five companies. There are a lot of other tech companies that make up that sector, but yeah, I would agree with you from our analyst point of view. They're starting to look attractive. What I will say is, just as investors, what we should know is how these five companies perform and how the technology sectors perform is going to have an outsized influence on how indexes perform, how this S&P 500 performs. So all I'm trying to say is that be informed as an investor and know what the driver of your returns is going to be. But yeah, you're right about what our analysts think. All right. So Lisa, winning once again, participant of the day. I mean, it's not too late for anyone else to ask. I think this is your third question, so people are going to have to get on this. All right, so Lisa's saying, do tech stocks underperform because less investors buy into them, or is it another reason? All right, so that's what we're going to talk about now, sort of why. And once again, we don't know. Everything that people say about the market is speculation at the end of the day, because it is the action of millions of different buyers and sellers that drive this. So do tech stocks underperform because less investors buy into them? Absolutely, right? So at the end of the day, we know that that's what that means. That because the market is basically a marketplace trying to find an equilibrium between buyers and sellers, that yeah, if something goes down, there are less buyers and sellers. But is there another reason? Well, what has happened is the market has gotten a little bit spooked about, and we talked about this before, about interest rates. So partially through some of the inflation readings that came out of the US in April, but people are starting to think, hey, maybe maybe central banks, who have all said that they're going to keep interest rates at close to zero for an extended amount of time and will tolerate higher inflation, maybe inflation is going to get to the point where they can't tolerate it anymore. So maybe we're not going to have these ultra low interest rates for an extended period of time. So what that does is it makes investors recalibrate what they think about growth companies, where a lot of the growth is way out into the future. So obviously the big five that I've shown have still held up, but there are also stocks that are pretty net. I think Tesla's down 16, 17% this year. There are stocks that are high growth potential stocks that people are starting to back out of and going into more value plays. And part of the reason is, okay, well, Vince has a good question. I can't see how inflation is going to affect tech stock. What it affects is the valuation method that people use. So basically, if inflation forces interest rates up, it means everyone that's using everyone who's sitting there and using a discounted cash flow method to value stocks is going to start to change their models. They are going to put in higher interest rates. So mathematically, what does that affect? We're discounting back future cash flows that companies make. Mathematically, the companies that have more future cash flows in way into the future are going to get hurt more when we discount them by a higher rate. It means they're worth less. So that is what's happened as interest rates have fallen. That is why valuation levels have increased. And people are always arguing, and we don't know, like, is that increase justified? But either way, if interest rates go up, it is going to hurt growth companies. And that is what a lot of the tech companies are. And it's just the way that we value companies. It's the way that we value cash flows. So hopefully that helped. Oh, Paul's saying, thanks for suggesting Equity Mates on podcast. I visited the guys at the ASX Investor Day. I saw that they were there, and I saw they put a bunch of stuff up on Instagram, so they were there. Shani was very worried because we were jokingly talking about our beef with the equity mates, and she was very, very concerned that this was going to turn into some sort of like Facebook comment war, but it hasn't happened. So Shani does not have to watch her train videos to calm her down because that has not happened. All right, we're out of questions. Good times. All right, so if anyone has any other questions, please send them through right now. Okay, we've got a question. Every time I say that, then we get questions. But yeah, send through any questions. We'll obviously end this thing once we run out. So the anonymous attendee, why do interest rate rising impact growth stocks more than value stocks? Okay, so what we're looking at here, I wish I had my stupid spreadsheet, is the way that we value stocks, and not we as in Morningstar, the way that everyone values stocks, every professional investor at least, is they are, of course, when you're buying a company, what are you buying? You're buying the future. So that's why we look at financial statements, and they're important to look at, but we're really looking at financial statements as a way to try to understand what's going to happen to a company in the future. So we want to estimate, if you think about this, if you buy Facebook today, doesn't really matter what it did for the last 10 years, it matters what it does into the future. So whether you are creating a detailed model like an analyst does or not, you are buying the future earnings of a company. But there's a principle in finance and investing that a dollar today is worth more than a dollar in the future. So if your company is going to earn $10 in the future, of course that isn't worth $10 today. So you need to discount that. And how do you discount that? You discount that. Well, you can discount it in lots of different ways, but you discount that. And one of the inputs into that is interest rates. So if there are higher interest rates, you are going to discount future cash flows more, all right? So higher discount rate, things in the future are worth less, cash flows in the future. So if you are a company that has all of their cash flows far out into the future and relatively less cash flows today, then it's going to mathematically have a bigger impact on you. So basically it's just math. So an example, let's use Tesla as an example. All right, so Tesla has just turned a profit like a year ago or something like that. So they invested a bunch of money. They've obviously built these cars, which are apparently great. They sold all these cars and they didn't have the manufacturing capability, but they've worked all this stuff out, right? So now they're producing a lot of cars. They're starting to turn a profit. But if you are an investor in Tesla, you're not buying Tesla for what they're going to make in the next couple of years. They're not paying a dividend. You are buying them because you think, especially at this level, this valuation level, you think that they're going to revolutionize the way that car technology, right? And you think they're going to do it, not all the other people that are doing the same thing and building electric cars, right? So that is your thesis. But these cash flows for Tesla are way out in the future. When they really start making money is way out into the future. So if that discount rate goes up, it's going to impact Tesla more than if you're an investor in ExxonMobil, who cash flows in the future will probably decline as all of a sudden people start driving electric vehicles. But over the next couple of years, they're going to continue to still make a lot of money. So mathematically, when you look at those cash flow profiles, interest rates going up will have a bigger impact to growth companies whose growth is way out in the future. Interest rates going up will impact all companies, right? It will impact all the valuation levels on companies. But yeah, it will just affect growth companies more. Okay, so this is a good question from Paul. And this is a good segue. It's like Paul is advertising our next podcast, Shani. Right? So Paul's saying ASX Investor Day was incredibly bullish on Megatrends. So Paul's saying, I'm a Morningstar Premium user. Thank you for that. You attend our individual investor conference. That's good. So you've seen me embarrass myself on stage. And you listen to our podcast. So that is perfect. Thank you for all of that. So he's feeling that Morningstar are very much value investors. My comments. Okay. So let me, well, All right, let me take on two comments. So Megatrends. So Megatrends, basically, what we are doing our podcast on that we'll record right after this is these thematic ETFs, and thematic ETFs buy into these megatrends. So a megatrend is very simple, right? Like that ACDC. So that's perfect. They're investing in battery technology and lithium. And the thought is very simple here, right? As we try to reduce our carbon footprint collectively, that all of a sudden battery technology becomes a lot more important. So we'll have electric cars and we'll have smart grids and everything else. Where storing power is really, really important. That we're not going to have these on-demand power plants, or we can just turn them up, turn them down. But yeah, those are megatrends. And people like megatrends, particularly in my opinion, marketing companies at ETFs like megatrends because they're really easy to sell to people. Because as humans, we all get very, we like narratives, and we like narratives around why we're investing. And nobody's gonna say anything bad to you when you're standing at the barbecue with your mates talking about how you're investing in climate change. And I'm gonna say, oh, that's really, really smart. Like, right, so climate change is a problem. We are collectively trying to fix that. That's gonna be a great investment, maybe. Like maybe it will be. So if I was to go present on stage at the ASX, yeah, maybe I'd talk about a megatrend because everyone sit there and nod their head at me. Historically, those have not been great investments. And we go through a bunch of examples, or we will go through a bunch of examples on this podcast we released on Sunday, but all sorts of megatrends that change society have turned out to be lousy investments. And the beneficiaries of those megatrends were different industries and different people, right? So anytime that you have anytime that you are inventing something new, we don't exactly know who it's going to benefit the most. Is it the producer of it? Is it the consumer? Is it the supplier? Is it some ancillary industry? That's my concern about megatrends, that just because something's going to happen doesn't make it a good investment, and that's why I like that Philip Morris example. So your second part of your question is my feelings that Morningstar are very much value investors. If you go and tell our analysts they're value investors, they will disagree. What I would say is that Morningstar's methodology and approach doesn't at least appear like it works very well when we are in overvalued markets that are bubbles. Now, I know my opinion about what's going on right now, but we'll have to see if that's actually going to happen. So I would say that focusing on valuation and focusing on cash flow doesn't work very well when all of a sudden they put out a FANG ETF in 10 companies and it gets $200 million in assets in less than a year, right? So it doesn't work very well in that environment. It doesn't really work well in an environment where people are buying things based on message boards and memes and yeah, that's my opinion. So I would say it's not necessarily value related. It is certainly valuation related. That doesn't mean it has to be a value stock. That means, as Warren Buffett would say, you want to buy a great company, a company with a moat, and a company, and you'd be willing to pay more for that. You still have to focus on that valuation component. So that was my long-winded answer to Paul's question. All right, so now we're out of questions, but it took me so long to go through my little rant, as Shani would say, that we're close to the end. So we'll be back on Thursday. I'll be back on Thursday, where I remember what we were talking about. Shani's going to pull it up. Anyway, I'll be back on Thursday. You can see the schedule. So thank you guys very much for joining. If you have any questions, please send an email to mark.lamonica1@morningstar.com.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.